Hello everyone, my name's Philip. I'm just going to be going over question number 3 from test number 2 in BUSI 3001. For some of you, I'm a fellow classmate, and for others, I'm just a stranger off the internet. But if you want to figure out about how this consolidation is going to happen, feel free to stick around. And I apologize I'm posting this so late, but just like many of you who are going to be watching this video, I was also very busy studying, and I hope everyone's studying is going well because the exam is tomorrow. Alright, so I posted this modified marking scheme in the description below, so please feel free to download that if you would like. And this is just simply the way I like to set up my problems. And it's not the only way to do it, but it's certainly one way. And if you'd like to skip to any particular part of the video, I'll post links in the description to skip to any of the parts of the problem. Alright, so let's get started. Okay, so I'm sure you guys know that you would definitely want to start by calculating the acquisition differential and goodwill. So in the problem, it tells us that we have a the cost of the sub is $300, and to figure out the implied value at 100%, we simply divide the $300 by 80%, providing us with $375 for 100% of the sub. And that's pretty easy, and we're just going to continue through this. So the carrying amount of net assets, once again, I'm sure you guys are familiar with that it's equal to shareholders' equity, so we subtract 190, which is provided in the problem, to get acquisition differential of $185. So that's a piece of cake. And now we're going to carry on to figuring out where our fair value excess is. So we have some inventory, land, and equipment. So in inventory, we have a negative fair value, so it drops by $70. In land, it increases by 50, and in equipment, increases by 160. And giving us a total fair value excess of $140, and that subtracted from our acquisition differential leaves us with a goodwill of $45. So that's relatively easy and basic. But we're gonna move on to our acquisition differential amortization table. So once again, this is just how I like to set up my problems right here. It provides us with all the details we need. So the useful life balance at the beginning of, so when we acquire the subs, this should actually be year 1. Whoopsies. And the amortization, and that's from year 1 to year 4. We do this to encompass all the periods before, and then the year that we're doing the current consolidated statements in, and then the ending balance. And just a note, if you do sell off any of your acquisition differential, you should probably make a separate column in the given year, just in order to reflect that. I mean, I know David did a video about that, about a custom problem. I'll see if I could put that in the link, in the description below as a link. All right, so inventory, we had a negative value at the beginning, a fair value excess. And since inventory is a current asset, it'll be removed from our books within a year, so that'll be gone right there. And the balance at consolidation is 0. Land has an infinite useful life, so 50, and we carry over the 50 all the way over here, so we can't really amortize that. Our equipment has a useful life of 4 years, and it'll be amortized over here within the 4 years, so giving us an acquisition differential value of that of 0 by the end of December 31st, year 5, so on consolidation. And then over here we got goodwill, which technically has an infinite useful life, but it should be impaired, remembering that we impair it downwards and we can't appraise it upwards. So what I've done here is I've made a nice little picture over here to show what's going on. So we have the appraised values. These were provided in the problem, and it said it's appraised every other year. So we have 60 at the end of year 1, we have 60 at the end of year 3, and then we have a 40 by the end of year 5. So our goodwill over here was 45, and I just did this to show you that the appraised value is greater, so we're not going to use that. That's why there's a little X there. So 60, 45, we can't use that, but since this one is lower, it's 40, and this is 45, the initial goodwill is greater, we can impair it by the difference between these two. That's why there's a check mark there. And the impaired amount will be 5 right here. So the difference between those two, that's the impaired amount. And then we should have a total balance of 90 at December 31st, year 5. And now we're going to move on to our supporting calculations. So for our supporting calculations, we're going to start off with intercompany transactions. And we're going to start off with rent here. So upstream and downstream rent. Upstream simply meaning that the sub is providing rent to the parent, and downstream meaning that the parent is providing rent to the sub. And the parent has clearly not paid yet, as indicated right here. This is provided to us in the problem, but it's just nice to write down so that we don't forget it. And related to this, that'll create an accounts receivable and accounts payable on consolidation that we have to take out. So I like to record that just so I don't forget about it. And last but not least, our dividends over here. So what we're going to want to do is we're going to want to remove the portion that belongs to the consolidated entity. So since we own 80% of it, we're going to want to remove 80% of the dividends that we receive from the sub. So 190 is the full amount of dividends that the sub paid. We multiply that by 80% ownership, and we get 152. Now moving on to intercompany profits. So we're going to start off with profits in the inventory first. So remembering that inventory is a current asset, and what that means is that since it's a current asset, it will come off our books within a year, assuming that we sell it. So the opening inventory is generally considered to be realized, and closing inventory is generally considered to be unrealized. So over here, we have downstream and upstream. So downstream meaning that the parent is selling to the sub, and upstream meaning that the sub is selling to the parent, and these are located in the inventories of here it would be in the sub, and here it would be in the parent. Same thing down here. So we're going to multiply that by the gross margin, providing us with the profit that's actually in the inventory of both the sub and the parent. We take our tax, which is 20%, and we get our post-tax amount over here. Now remembering to read the test or the exam carefully, because I had actually missed this on the first problem on test 2, and I extrapolated for the tax. So definitely want to note that. I won't be doing that for the exam. And we do the same thing over here for closing. So we have our inventory, multiply it by the respective gross margin, receiving our profit, a pre-tax profit that is, take the tax rate, receive our post-tax profit. Now moving on to the sale of equipment. So the reason why this question was nice is that we see both downstream and upstream sales of equipment. So we will get to deal with that when we're doing our consolidated net income and retained earnings calculations. So over here, the downstream sale, so the parent sold to the sub on January 1st, year 4. And we don't actually need all of this information over here, but it's nice to have. Generally, I'll just calculate that, and that should be enough. But since we're in Excel here, it's a lot easier. So on a test, I wouldn't really waste my time with this block right over here. Anyways, moving on. Our amortization in year 4 is 10. We'll get 40. And then same thing over here, and we'll get 30. And then we just take the tax across. Easy enough. And the reason we'll want to come up with this is because there is a gain here, and we will want to be removing that from the profit and the retained earnings of the sub and or the parent. And we're doing the same thing down here, just with, I'm pretty sure, a different useful life. And that's why these numbers are different. And we had a different starting value, of course. All right, so we're going to move on to the calculation of consolidated net income now. So now we're going to be calculating consolidated income for year 5. So here we're just going to be calculating the entire consolidated net income and then attributing it to the parent shareholders and the non-controlling interest. Although on a test it might just be quicker to do it right away for the parent and then come up with the non-controlling interest portion. But we're going to move on now, and just to know over here that we're not including the rent in here. We're going to use the rent of $20 that the parent still owes the sub. As an example, we're not including that in this calculation because although it'll appear over here as an expense, and it expense over here, it would be going on over here as income for the sub. So it'll technically cancel itself out. And this becomes a lot more clear when you do the income statement, although we're not going to be going over that for this question. All right, so over here, we're removing the dividends that the parent had received from the sub, so 80%. We had already calculated that in our supporting calculations, and that's 152. And then we want to remove the unrealized profit in closing inventory, remembering that closing inventory is a current asset, so it's eliminated from our books within a year. But this is still inside that year, so we can't possibly recognize those profits at this time. But what we can do is the profits that were made last year in opening inventory, we could recognize those now. So we recognize those as $14 and $14.4. And over here, we're recognizing the amortized amount, after-tax amount. That's what that is. So when we came up with that, it's the amortized amount, and that's why I said we only need 2 lines. We need the amortized and the bottom value where we come up with the still unrealized gain. So as we're amortizing it, we're realizing the gain. Now we're going to move on to the subs portion over here of net income and how much is included and what we're going to consolidate out here. So we're going to take away the subs closing inventory profits over here as they are unrealized. And what we're going to do here is we're taking out the acquisition differential amortized over here as well. And we're also going to add back realized profit in opening inventory since it has been more than a year, and realized gain on sales of equipment. And just a note here, make sure you use the correct one, so you label whether it's upstream or a downstream transaction and which one you're actually using. It's quite easy to get confused between this opening inventory and this opening inventory, or this realized gain and this realized gain. So just make it clear for yourself. And then we'll come up with the subs adjusted net income over here. We want to add these two together to get the full consolidated net income. And this consolidated net income is the same net income that should appear at the bottom of any consolidated income statement. But then at the bottom, we usually have that portion where it's attributable to, and then we have the parent and the non-controlling interest. So over here we have the parent's shareholders. And so we start off with the parent's portion of the adjusted net income, so right over here. And then we're taking the subs adjusted net income, which is right over here, and we're just multiplying it by the parent's ownership portion, which will give us 177.12, and adding that together, which will give us a total of 337.92. So that's the profit attributable to the parent, and then we have the non-controlling interest, which is even easier because we don't have any of this side stuff over here. We just multiply that by the non-controlling interest, and that'll give us $44.28, or I don't even know if these are cents. It might be in thousands. Anywho, that's it for the consolidated net income. We're going to move on now to the consolidated retained earnings calculation. All right, so now we're going to go over the calculation of consolidated retained earnings. We're going to focus on the year-end approach, but we also have the beginning of the year approach here. And the reason why we would ever want to use that is if we have a little bit of extra time on the test, you might want to do that in order to verify your answers. I wouldn't try to fit this in before finishing the test. Once again, it's basically the same calculation as here, just a little bit different, and it'll only work if you have specific pieces of information. We're going to start off by going over the year-end approach first. So we're going to use the parent's year-end retained earnings. This is non-consolidated over here, and that's 530 provided to us in the problem. And then we're going to want to take out any unrealized profits. So the first one we want to take out is closing inventory. And the reason why we're not adding back the realized opening inventory is because it's actually already in here. So in the retained earnings that they provide us, both the closing inventory and opening inventory profits are included. But since we can actually realize the opening inventory, once again going back to that idea of it being a current asset and it being on our books for over a year now, then we can now realize it. But we can't do the same with the closing inventory, so that's why that's here. And unrealized gain on sale of equipment, this is just the bottom number over here. So after we take our amortization and we subtract the amortization, we have this number at the end of the year. And this is what's left unrealized. We'll still need to amortize that. So this is unrealized. So once again, it's included in the non-consolidated retained earnings, but we want to take out that gain and realize it over the useful life. So that'll give us an adjusted retained earnings of 496.4. And now we want to take the subs retained earnings over here, and that's 400 at year end. And we're going to want to subtract the retained earnings at acquisition. So we just want to see the difference, what happened since they acquired it to this date. And that'll give us an increase of 320. And we're going to want to take out, once again, closing unrealized profit in closing inventory and unrealized gain on sales of equipment, making sure that we're picking the right ones over here. So these ones are obviously upstream, these ones are downstream. So distinguishing the difference between the two, it's very important. And we want to take out the accumulated acquisition differential amortized. And the reason why we want to do this is because over here in this amount over here, it's not actually, the acquisition differential amortization isn't actually included. So all the acquisition differential that happened between the acquisition till now, we're going to want to take that out because that had already happened, including the one for this year. And then we should get an adjusted retained earnings of 165.8. We'll multiply that by 80%, giving us 132.64. And then we can add those two together to get our consolidated retained earnings. And that's it for the consolidated retained earnings calculation. But we're going to go over the beginning approach now, which is relatively similar with a few twists. Okay, so over here, we start with the retained earnings at the beginning of the year, or it might also, in the problem, it might also be stated that it's at the end of year 4. Regardless, whether it's a day off, it'll probably be the exact same. It's whether it's provided to you that whether you'll be able to use this method or not. So if it's provided to you, the retained earnings at the beginning of the year, then we start off with the parents reported. And then we want to take out unrealized profits, but realizing or recognizing that opening inventory is now the closing inventory for this year. So if this was December 31st, year 4, the opening inventory has not been it hasn't been more than a year, so it's not sold off yet. So we now treat this as though it were closing inventory right here. And we do the same thing with the sales of equipment. And as I said, you don't have to fill out the entire table. If you are using this method for coming up with retained earnings, then you'll have to fill out more of that, the amortization of the gain on the sales of equipment. So this is currently what's unrealized. for the gain on equipment. And then we'll come up with 353.6 over here. So then the retained earnings, and these are provided to us. The retained earnings for the sub at the beginning of the year is 390 at the beginning of the year, or ending of the last year. And then we want to subtract the acquisition amount of retained earnings at the beginning. So it's the same as over here. And that'll provide us with an increase of 310. All right, and then over here, we're going to want to take out the same values, but once again, doing the same as over here. So the opening inventory is now the ending inventory for January 1st, year 5, or we should treat it as such. So taking that out over here, and once again, filling in the rest of that table, or at least one row above, in order to figure out what the unrealized amount was a year prior to what it was over here. And then we're subtracting the accumulated acquisition differential amortization, as we did over here, just once again, making sure that we're doing it for a year prior. And then we should get an adjusted amount for the sub's retained earnings of 134.4, multiplying that by the parent's portion, which is 107.52. That will give us a consolidated retained earnings at December 31st, year 4 of 461.12. And I realized that here I did write December 31st, year 4, and here I used January 1st, year 5. But that's just to sort of show that whether it's stated at the beginning of the period or at the end of the previous period, it's pretty much the same thing. So now what we're going to do here is we're going to add back the profits that we calculated. So now this is going to be for year 5, so what's happening during year 5. We're adding back the profits that are attributed to the parent shareholders. So that was 337.92, and we're going to take out the dividends. We're going to take out the dividends over here that the parents. It shouldn't say to the parent shareholders. It should just be the dividends that the parents had paid out to. Oh yeah, that's correct. That's correct. And so we take that out, and then we should get the same value over here. Now, this information a lot of this information was provided to us, making this part easier. It might not be. So if it wasn't provided, you might not be able to do this check. All right, so now we're going to move on to the calculation of non-controlling interests. So going over the calculation of non-controlling interest, once again, you could use the beginning approach or the year-end approach. And just like for the last problem, we're gonna go over both. We're gonna start off by doing the year-end approach, and just like the last problem, you shouldn't do this one until you finish the entire test or exam. So just really worry about this one and use this one as a check if you have time. All right, so starting off, so we're going to use the sub's net assets at December 31st, year 5. And once again, that's equal to shareholders' equity. So we're assuming that the common shares is, actually this is taken from the question, is 110, and then we're adding 400 for retained earnings, and they'll provide us with 510 over here. And we're going to add the unamortized acquisition differential. And the reason why we're doing that is because we want to put it up to its fair value. So when we were provided this, we didn't add on the fair values that we did at the start. So we had the fair value excess in our Goodwill calculation, but we haven't done that here since we took these off of the unconsolidated statements, or haven't done any work here. So we're just adding these right back over here, and you could find this number in our Goodwill and acquisition differential calculations. So then we move on by subtracting everything, all the purchases or all the gains and profits here that are upstream, since it's related to the sub. So the ending inventory over here, this is an upstream. These are upstream profits over here. They're unrealized, so we want to subtract those, as well as these gains over here. So taking those out, and then we're going to get adjusted net assets over here, and then we just take the non-controlling interest ownership, which is 20%, and then we get non-controlling interest at December 31st, year 5 of $108.16, or whatever units we're using here, because it's not sure if it's not said if it's in thousands or whatnot. Alrighty, so now we're going to do the non-controlling interest calculation for the beginning approach. So very similar as to the last one, we basically just do the same calculation with the numbers at the beginning, and we add on what was done throughout the year. So the sub's net assets at January 1st, year 5, so at the beginning of the period, once again, like shareholders' equity, remembering that over here we still have the same $110 for common shares, but we got to add it to the beginning retained earnings, assuming that the common shares were the same at that point in time, at the beginning of the year. And that'll give us $500. We're going to want to add back the unamortized acquisition differential over here, and take out the unrealized profit in opening inventory. Remembering that opening inventory is now, well, it's currently at this date, right? So it hasn't been the full year, and it is a current asset, so it's unrealized. So right here, we're subtracting it out and using the other value over here for the unrealized gain on the sales of equipment. So realizing that this is at the beginning of the period, this is at the end of the period. So really what you could do is you could just add back the amortization to this amount and get that. All right, and then you should get an adjusted non-controlling interest of $509.40, and you multiply that by 20%. You'll have non-controlling interest ownership at the beginning of the period of $101.88. So now what we got to do is, at the beginning of the period right here, now what we got to do is we got to add in whatever has happened throughout the year. So during the year, we take the profit attributed to the non-controlling interest shareholders, which is 44.28. We add that in and we subtract out the dividends that they paid, but relevant to the non-controlling interest, so 20% of the dividends that they paid. And this information over here, the 190, is provided in the problem. And that'll give us 38. We take that out, and that'll give us $108.16 over here, just like right there. All right, so now we're going to move on to our consolidated statement of retained earnings. So part of the problem was to do a consolidated statement of retained earnings. And in the answer key that was provided to us, we actually didn't have this, so here it is right now. And what I really think is cool about this is that we did both methods of calculating retained earnings, and you'll notice that the beginning retained earnings matches the consolidated beginning retained earnings that we used in the beginning of the year approach for calculating retained earnings. And this one matches the ending, so it's really nice or cool to see that come together. But now we're going to discuss how we calculate all these values without actually doing the beginning approach, which is relatively easily. We just sort of work backwards. So ideally, you would just calculate this amount over here, as we saw, and we would have this value and that value because we've already calculated them. So this value over here is net income, but this is attributed to the parent's shareholders, and this was provided to us in the question. So all we got to do to come up with this value is do the opposite operations on this. So we would add 170 to that and subtract 337.92 cents from that, and we should get 461.12 cents for the opening retained earnings. And this is simple enough over here. Now we're going to move on to the consolidated financial statement of financial position. So for the consolidated statement of financial position, or actually in the question it says consolidated balance sheet, but I'm pretty sure they're the same thing, so it doesn't really matter. So for this over here, we got our assets, liabilities set up like that, and of course generally what I like to do when I start these questions is I won't just do it line by line. I'll write in everything that I need to put there, so I'll know that I'll have all the accounts they had. So they presented us with everything from inventory, inventory, accounts receivable, land, equipment, and that's pretty much all they provided us with. But we'll know that since there is some intercompany transactions, there'll definitely be some deferred taxes, definitely be some goodwill, because we calculated that at the start. I do the same thing over here, so I'll write everything down and I'll just add the non-controlling interest. And then once I have all of this down on my test, I'll carry on by adding each of the calculations, and then I'll do the calculations afterwards. But for the sake of this video, I'll just go through this line by line now. So what we're going to want to, so these summation signs over here are simply mean that we're adding together the parents and the subs values that they have on the balance sheets provided in the question. So we're adding together the accounts receivable that they have in the question, but we're taking out this $20 as we saw in our supporting calculations section, because, well, the parent hasn't yet paid, or sorry, the sub hasn't yet received it, and they're still waiting to receive this $20 of unpaid rent from the parent. So we're taking that out, and you'll see that over here as well, because the parent hasn't yet paid it, and it is an intercompany transaction. Over here, we're just summing the two together, and we're subtracting $36 of cumulative profit in closing inventory. And of course, that's unrealized profit, and it's before tax. I find a common mistake that I make when I'm doing some practice problems, and I'm not quite paying attention, just flying through the problem. I'll accidentally use the after-tax inventory instead of the pre-tax. So very important right here. This could be the cause of your balance sheet not balancing, and it would probably be one of those things that's a little bit more difficult to figure out. And over here, we're adding the two together, and US, what that means is upstream and downstream over here, and UR is unrealized gains, just because there's a smaller room to work with over here. And we're taking out the upstream and the downstream unrealized gains. And once again, these are before tax. So we don't want to take the after-tax amounts. These are before tax. And over here, we're adding back the unamortized acquisition differential. The reason why we're doing this over here is because our land was actually appraised higher, and we're not amortizing any of it. So we're adding it to reflect its amount over here. And our goodwill, as we calculated, and our deferred taxes. The reason why I like to add together my ending inventory both, which is in either the unrealized or the opening balance, is just so I could quickly plug in like this, and I don't really even have to think about it. So right over here from our supporting calculations section, we have 7.2 of deferred taxes, making sure that this is unrealized, and so we haven't paid taxes on it, and that's why we have a deferred tax asset. And the same idea over here. So related to this would be related to these over here, and it's this much tax. Alrighty, so now moving on to the liabilities and shareholders' equity section. Once again, we took out that unpaid rent. We have the common shares that the parent had, which we assume are going to be the same unless mentioned otherwise. And over here we have our retained earnings and our non-controlling interest that we calculated in previous slides, and providing us with an amount of $1,067.20 to balance at. Once again, not sure if these are cents or if this is in thousands. It doesn't really say anywhere. We're going to assume that it's not, just because I've been saying cents. Anyways, that's pretty much all for this video, guys. And just as a final note, this question didn't include a sale of any of the assets or the capital assets that we had in our acquisition differential. And I know in the custom problem that John had provided us with, and that David went over in the tutorial, there was a little bit of that. So I would recommend that you go over the custom problem, and I know David had done a video for that. I'll see if I can post that in the link, in the description below as a link. And that's something you definitely might want to pay attention to. I have a gut feeling that we'll see that on the exam. And but see, that's about all for now. And I want to wish you guys all a good luck. Good luck on the exam tomorrow. If you liked the video, give it the good old thumbs up. And if you have any questions, don't be shy and just ask them below.